There is one business out there right now that I view as a pure turnaround play. The business has an instantly recognizable brand, and for many people, it is an integral part of their morning routine. Despite having woven themselves into the fabric of America's daily routine, they seem to have fallen into difficult despair. I described this in an extensive video on Starbucks a couple of months ago. It was after their horrific earnings report of Q2 fiscal year 2024 and the disastrous Jim Cramer interview with their now fired CEO. I laid out why Starbucks has declined and what they needed to do to get to growth. Welcome to The Quality Investor. Well, I called it. What I described as Starbucks' biggest reason for their decline was confirmed by the incoming CEO. The new CEO is Brian Niccol. He was named CEO on August 13th, 2024, following the unceremonious firing of Lakshman Narasimhan. Starbucks had embraced the on-the-go culture for some time now, going all in on the mobile ordering experience. To be clear, the mobile ordering feature for Starbucks is a solid user experience. However, this was pushed at the expense of the core offering of Starbucks. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. It began this transformation before Lakshman was even CEO. Starbucks built its business, and with it, a beloved international brand, on the coffeehouse being the third place. That is, the third place between work and home. A gathering spot for people to relax and socialize while sipping coffee and other caffeinated beverages. In my view, it was the devaluation of this experience, along with increased competition in the space, which I'll touch on soon, that led to awful results for 2024. This culminated in the now infamous interview Lakshman did with Jim Cramer. Jim Cramer grilled Lakshman on the poor earnings report during that May 2024 interview, probing into Starbucks pricing and the lack of warning to investors that this bad earnings report was coming. Lakshman spent the interview evading Cramer and looked clearly out of his depth as the man to run a $100 billion business. His downfall was swift after that. Elliott Investment Management had been amassing a $1.9 billion stake in the coffee giant. They had been pushing for changes behind the scenes for some time, but these negotiations became public in July, and by August 13th, Lakshman was out and Chipotle headman Brian Niccol was in. Elliott never confirmed they pressured the Starbucks board to fire Lakshman, although I find it hard to imagine that Elliott never broached the topic during months of negotiations and proposed changes to Starbucks by the activist investor. Brian Niccol had an impressive run as CEO of the casual Mexican joint Chipotle. During his reign, Chipotle's stock performed exceptionally well, rising in price by a factor of 8, an 8-bagger, if you will. On the day of his Starbucks hiring, Starbucks rose an incredible 24.5%, its best one-day performance in over 20 years. This rejuvenated the Starbucks investor community, and in one of his first public pronouncements, Niccol confirmed one of my main arguments for Starbucks' downfall. In his letter to the Starbucks community on September 10th, he stated exactly what I had claimed. Quote, "There's a shared sense that we have drifted from our core. We have an opportunity to make the store experience better for our partners and in turn for our customers." End quote. Now, after Starbucks' first earnings report since Niccol's hiring, I want to give an overview of their performance and assess whether the stock is worth buying at its now elevated share price. To be clear, the expectations for Starbucks were already declining in both revenue and earnings per share. Yet despite the lowered expectations for revenue and earnings, Starbucks still missed on the top and bottom line estimates. I'll go over some details in a bit, but it looks like Starbucks has some work to do to get back to growth. And on that, there were some key points in the earnings call. Niccol discussed the Back to Starbucks strategy that will be the blueprint for growth. The first point of the plan: prioritizing core identity as a welcoming coffee house. Exactly what I mentioned before. Starbucks becoming the third place again. And they will reintroduce condiment coffee bars and ceramic mugs. They will improve seating and ambiance in the stores. In fact, Starbucks is reallocating its capital expenditure to refocus on store design, thereby reducing new store openings. Another point I touched on in my video was the explosion of beverage options on the menu, trying to be all things to all people. What did the CEO say? Quote, "To improve throughput, quality, and consistency, we will cut down our overly complex menu to align with our core identity as a coffee company." End quote. Simplify the menu. Competition in the caffeine market has exploded. There are a myriad of beverage concoctions out there for consumers. And Starbucks was desperately offering up every concoction on the menu. Energy boosters, boba drinks, and more. All reactive to competition. That lacks focus. Quality suffers. Focus on your core and make it the best. It's almost like Brian Niccol saw my Starbucks video and stole all of my suggestions. But I digress. Let's briefly look at the numbers for the quarter and assess Starbucks' value as a stock. Is it worth buying now that we know the new CEO's vision, or is it worth waiting a few quarters to see how Niccol executes the plan? Starbucks closed today at $97.55, up 1.5% on the day. However, Starbucks doesn't seem to have benefited from the post-election surge in the market we've seen the last couple days. The last 5 days, they're actually down nearly 1%. However, zooming out a bit, we can see that massive price surge Starbucks experienced when Brian Niccol was named the CEO, going from $77 on the 12th of August all the way up to $95 on the 13th of August. And since then has been bouncing around relatively flat. So clearly the market is excited that they hired Chipotle's CEO. And they should be, considering his performance at the burrito chain. Looking at their Q4 for fiscal year 24 at a glance here, we can see they had $9.1 billion in revenue, which is actually down 3% year over year. The market was actually expecting about $9.14 billion here, so not a huge miss, but a miss nonetheless. But what's worrisome for the chain isn't just the 3% decline, it's the 7% decline in same-store sales. That came to about 6% decline here in the US, a 9% decline same-store sales internationally, but 14% decline in China. On the earnings call, Brian Niccol stated that there's intense competition going on right now in the coffee market there. So Starbucks is working through some troubles over there to try to get a footing into that massive market. Earnings per share, at least on a non-GAAP basis, came in at 80 cents, a 24% decline year over year. This missed analyst estimates of 89 cents, a 10% miss there. And you know, I always talk about operating margin. We can see that the operating margin, it came in at 14.4%, but 370 basis points decline year over year. So again, things not going in the right direction for Starbucks. Now, all this, of course, you cannot attribute to Brian Niccol. It's just his first quarter on the job, and he's just now starting to implement his plan. So it seems like Starbucks might have to go through a couple more quarters of decline before that plan really starts to take hold. We shall see. And the global store count ended at 40,199, which is a 6% year-over-year increase. I mentioned they're reallocating capital away from opening new stores to focus on redesigning current stores. Again, they're getting back to that core, that coffee shop experience. So going into the next fiscal year, 2025, we should expect to see that store count either remain flat or uptick barely. So what depressed those margins this quarter? So if we look a little bit deeper here, the first thing we see is that revenue's down 3%. However, store operating expenses came in at $3.8 billion compared to $3.7 billion in the prior quarter, a 4.3% increase. So revenues declined and their store operating expenses increased. And that we can see here, that was 42.8% of total revenue, the store operating expenses, up over from 39.7% last year, which resulted, of course, in that decline to 14.4% operating margin. So Starbucks is unable to control their expenses in a declining revenue environment. And on that revenue, there's something else interesting in this report. Looking at U.S. supplemental data here, we see that change in comparable stores, a decline of 6%, as they mentioned. But what made up that decline of 6%? There was a 10% decline in total transactions. But look at this. The change in ticket was 4%. That means the price increases that Starbucks had been instituting throughout fiscal year 2024 were causing the total price of each order to go up by about 4% in Q4 here. But customers clearly did not like those price increases. Total transactions down 10%. And I think that was the impetus for what Brian Niccol stated on the earnings call. He mentioned that they're eliminating the upcharge for non-dairy milks, but more importantly, no price increases through fiscal year 2025. He grasps that consumers have had enough with the price increases. He's freezed them. We shall see if that brings consumers back into the stores. And while prices aren't going lower, they're at least not getting higher. So it's going to be an interesting change to watch throughout the year for Starbucks. So what kind of growth could we expect from the coffeehouse giant here? It's tough to know because they suspended guidance due to the CEO transition. And based on the plan that Brian Niccol laid out, it seems like a lot of this is going to depend on execution. It seems like a good plan, going back to the core, what made Starbucks great in the first place. But it's going to be tough to estimate what kind of growth it's going to translate to until we see hard numbers for a few quarters in a row. So I'm going to stick on the very conservative side here. I'm estimating an operating margin about 15.25% in year one and pretty much remaining flat through year 10 on my base case at 16%. Up to 17% for the bull case, and then maybe declining slightly over the next 10 years to 15% for the bear case. Starbucks also has quite a bit of debt. We can expect them to pay down that debt over time, but the new CEO is not immune to debt. Chipotle did have a little bit of debt on their balance sheet. What's troubling for Starbucks is they do have a high interest expense margin, which is interest expense over operating income. At 10%, that means 10 cents of every operating dollar is going out the door to pay for interest. So long as they don't take on a lot more debt and they continue to increase their operating income over time, we should see that interest expense margin decline a bit. But I'm still estimating 10% for year one, maybe declining to 9% by year 10. They do have quite a bit of debt that's not coming due for a while on their balance sheet. Income tax margin, their effective rate, probably about 24%, in line with what their historical numbers are for Starbucks. And free cash flow conversion coming in at 88%. Pretty much right around what their 10-year average is. Especially now that they're reallocating capital to redesigning current stores rather than opening new stores. That should save a little bit on CapEx here in the next couple of years, primarily because it costs more money to open new stores than it does to retrofit old ones. And because of that, I see the free cash flow conversion rate increasing to 95 cents on my base case by year 10, and $1 on the bull case, and 90 cents on the bear case. They have been allocating some capital towards share repurchases, so I do have that estimated about 2% share repurchases a year over the next 10 years. In the dividend growth, that has come down quite a bit. They did increase their dividend to $2.44 per share, a little bit over a 6% increase from last year, but they have quite a high free cash flow payout ratio. Their free cash flow payout ratio sits at about 66.5% right now. And a lot of that is because of the depressed cash flows we've been seeing at Starbucks over the last few years. They've not done a good job compounding their free cash flow at all. So while their 5-year compound dividend growth is about 11%, and on a 10-year basis it's at 17.5%, I'm only estimating about a 6% dividend growth rate over the next few years due to that very high free cash flow payout ratio. 7% for the bull case and 5% on a bear case. The revenue growth picture doesn't look much better either. Their 5-year CAGR on revenue, first of all, is at 6.4%, and their revenues for 24 versus 23 essentially flat, 0.5% growth year over year. It might be slow going for Starbucks for a while. 5% on a base case total revenue growth over the next 10 years, 6% on a bull case, 3.84% on the bear case. I'm not going to feel comfortable upping these revenue estimates until we see if Brian Niccol can execute on his strategy. And we have to see that bear out in the numbers consistently across multiple quarters. Coming down to the bottom here, we can see what my ultimate free cash flow margin expectations based on these inputs here are for my base case, 10.5% free cash flow margin by year 10 on the base case, 12% free cash flow margin by year 10 for the bull case, and a 9% free cash flow margin on the bear case. So essentially, very slow growth, all in all, for Starbucks over the next 10 years. So looking at a few charts here for Starbucks, you can see what I mean. That revenue really has sort of flattened out over the last couple of years. Their earnings per share, not compounding at all. Very flat and choppy. And worst of all, you can see a decline over time in free cash flow. These are not good metrics for a business that's currently at an over 29 PE ratio with incredibly slow growth expected in the future. So personally, I have very low expectations for what Starbucks can do until we can see this free cash flow really start compounding and look a lot more like what this dividend increases are looking like here. And in fact, these dividend increases will slow if they can't get that free cash flow rising again. So coming over to my valuation for Starbucks, they closed the day at $97.55. And based on my discounted cash flow on a bear case, I have it $52.62. On a base case, $68.18. And on the bull case, $86.53. Those do not look like appetizing prices for Starbucks. Dividend discount, $70.92 for the bear, $78.83 for the base, $88.23 on the bull case, and the exit multiple is probably bringing up their valuation average as a whole a little bit at $101.78. My comps for the exit multiple are McDonald's, Yum Brands, Darden Restaurants, and Chipotle. The valuation average here, it comes in at $79.68. Forward PE of 23.7. In fact, a 10% margin of safety might be a bit high for Starbucks. I'd probably want to see him in the 20 to 30% margin of safety range here, which means they probably have to come down to about $60 a share to even look appetizing right now. Because right now, I don't see where the growth is coming from. They were having issues in China. Their same-store sales in the US are declining. People clearly do not like the price increases. So to me, it remains to be seen if Brian Niccol can institute his turnaround plan. But right now, I see Starbucks as a value trap. It always does look appetizing. You think, oh, this is such an iconic brand. They're always going to be on the up and up. But the numbers just don't bear that out right now. And I understand they're pretty popular within the dividend community. However, based on that free cash flow payout ratio, that dividend, that might be an issue, especially if they cannot get that free cash flow back up over the next couple years. That said, they do have an impressive ROIC, 26% on the trailing 12 basis, and the 10-year average is at 30.5%. The fact that their 10-year annualized return is actually under 10% just shows the mismanagement Starbucks has been under over the last few years. It's welcome news to have the change in CEO, to have the change in philosophy. There's still a lot of work to be done for Starbucks. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.